Well, I've lived through quite a few recessions now, more than I care to count, really. From the oil shock era that hit the economy hard in the 1,970 seconds to the dot-com bust in the early 2000s, the big one in 2008, and then the pandemic shock in 2020. And after watching all of that, after watching markets and families and businesses react again and again, one pattern keeps showing up. People with resources tend to move through recessions in a fundamentally different way than everyone else. And I want to say this carefully. I'm not saying that to brag. I'm not saying that to shame anyone who struggles. Not at all. A recession can be brutal. If you're living paycheck to paycheck, if your job is fragile, if you've got kids to feed, bills to pay, health costs that don't care what the GDP is doing, then fear isn't some abstract emotion. It's real, it's rational. It's your nervous system doing exactly what it's designed to do. But the reason I'm talking about this is because recessions aren't rare events. They're part of how modern economies breathe. The cycle expands, then it contracts, then it expands again. And the painful truth is that the people who are prepared, the people who understand the cycle and build a buffer before the storm, often come out of the storm stronger, not because they're better human beings, but because they're playing a different game. They're playing a game built on options, patience, and time. And believe me, there will be another recession. It's hard to predict the timing. And anyone who claims they can tell you the exact month is usually selling something. But the existence of another downturn is basically a certainty. So what I want to do is take the core ideas we already talked about and then go deeper. I want to add the missing layers people don't talk about enough. The psychology, the mechanics, the small practical moves that don't sound sexy, but determine whether you panic at the bottom or you hold steady and keep building. So let's start with the biggest one, the one that looks simple but is incredibly hard in real life. Staying calm. In 2008, the S&P 500 fell about 57% from the 2007 peak to the 2009 trough. That's not a normal dip, that's a free fall. That's the kind of drop that makes you feel like the entire system is breaking. And people reacted the way humans react. They ran, they sold, they pulled money out, they tried to find safety. And I get it, because when your screen is red for weeks, when the headlines are screaming, when you hear the word collapse over and over, it doesn't feel like a temporary downturn. It feels like the end. But here's the cruel math of panic. When you sell at the bottom, you don't just reduce risk, you convert temporary volatility into permanent loss. You take something that could have healed over time and you lock it into your financial history. And then to make it worse, what usually happens is you don't buy back in until the headlines feel safe again, which means you sell low and you buy high. That's the trap. This isn't a poor people problem. This is a human problem. It's how our brains are wired. We feel losses more intensely than gains. We overweight recent fear. We treat uncertainty like danger. And in a recession, your brain is basically screaming at you to do something, anything, just to stop the feeling. But the market doesn't reward emotional relief. The market rewards disciplined behavior over long stretches of time. One of the most useful things you can do before the next recession is to train yourself right now to recognize the emotional moment when you're about to make a relief decision. The decision that makes you feel better today but costs you years of progress later. When you can spot that moment, you can slow down, breathe, and switch from emotion to process. And process matters because recessions end, every downturn eventually gives way to recovery. Even events that felt like permanent damage, like the Great Depression, eventually transitioned into growth again. Even something as shocking as the 1987 crash where the Dow fell 22.6% in a single day, did not end capitalism. It did not end investing. It was terrifying. And then the world kept going. Even the dot-com crash, where the NASDAQ fell about 78% from its peak to its 2002 low, was followed by waves of real innovation that reshaped the world. The people who survived were the people who didn't confuse volatility with destiny. Now, I'm not saying stay calm like it's a magic trick. If you're facing job loss or medical bills, or you're choosing between rent and groceries, calm is hard, really hard. And that's why the second layer of calm is not just mindset, it's engineering. You build structures that help you stay calm because your situation becomes less fragile. That brings me to the thing people with resources do that looks boring but changes everything. They build slack. Slack is time, money, flexibility, and margin. Slack is what prevents a bad month from turning into a life crisis. Slack is an emergency fund. It's low debt. It's not maxing out your lifestyle during good times. It's not building a life that only works if everything goes perfectly. There's a reason mainstream guidance keeps coming back to the idea of an emergency fund, a cash reserve specifically set aside for unexpected expenses or income loss. When you have that reserve, you don't have to make desperate moves in a recession. You don't have to sell investments at the worst moment just to pay the electric bill. You don't have to accept the first terrible job offer out of fear. You have options. And options are power. And by the way, recession isn't even a clean, simple label. A lot of people repeat the line that a recession is 2 consecutive quarters of negative GDP. But the group that officially dates US recessions, the NBER uses a broader approach looking at things like employment, income, production, and how widespread and persistent the decline is. The point is, by the time the label is official, the damage and the fear have often been building for a while, which means your preparation cannot start when the news anchor says the word. Your preparation has to start during the calm period before the storm. Now, let's talk about the second core idea, buying when others are selling, but let's make it more realistic, because most people hear that and think it means you have to call the bottom, and that's not the point. The point is to have a plan to keep investing when fear is high, because fear is exactly what creates better long-term prices. In 2020, the S&P 500 fell roughly 34% from its February high to its March low. That drop happened fast. And what did people feel? They felt whiplash. They felt like the floor disappeared. And then the market recovered with incredible speed. If you were out of the market because you panicked, you missed that recovery. If you tried to wait till everything felt safe, you often bought back higher. This is why the most practical buy when others sell strategy for regular people is not heroic contrarian timing. It's consistency, it's dollar cost averaging, it's investing a set amount on a schedule through good times and bad. So you don't have to be smarter than the market. You just have to be steadier than your own fear. And here's another truth that people with resources understand. The market often starts recovering before the economy feels better. Stocks are forward-looking, they price expectations. That means you can have a moment where layoffs are still happening and the market is already climbing. That's emotionally confusing. It feels wrong. But it's common, and if you're waiting for the world to feel safe, you'll often be late. Now, I'm going to add a third layer to this. What you do with your behavior matters as much as what you buy. Because even if you pick good investments, you can still lose to your own timing. There's research on investor behavior showing that the average equity investor tends to underperform the market over long stretches, largely because of emotional decisions, buying after gains and selling after losses. One summary of Dalbar-related findings cites a long-run underperformance on the order of a couple percentage points a year, which doesn't sound dramatic until you compound it for decades. Couple percent a year is the difference between retire with options and work forever. And their more recent reporting has highlighted how large the performance gap can become in a single strong year when investors miss big days by jumping in and out. That's not because investors are stupid, it's because investors are human. So when I say buy when others sell, I'm also saying stop self-sabotaging. Stop trying to turn long-term investing into a daily emotional contest. Build rules you can follow when you're scared. Automate what you can. Put friction between you and impulsive selling. Decide your asset allocation and rebalance rather than react. Make your process stronger than your mood. Now, the third core idea was protecting income streams. And this deserves more detail because income is what keeps you alive in a downturn. People talk about investing like it's the only lever. It isn't. In recessions, the most important asset for most households is still their ability to earn. When a downturn hits, your risk isn't just my portfolio's down, your risk is my paycheck disappears. And if your entire life is funded by a single income stream, the fragility is obvious. If that stream breaks, everything breaks. So the smart move is to diversify your income the way you diversify investments. And I don't mean everyone needs to become a real estate mogul or start 5 businesses. I mean you build at least one additional pipe, something that can keep flowing if your main job slows down. A small freelance skill, service you can sell on evenings or weekends, a digital product, a tutoring gig, an online store, consulting, part-time contract, a YouTube channel even. Not because it'll make you rich overnight, but because it creates resilience. And there's a second part of income protection that people ignore. Employability is an asset. In recessions, companies cut roles they can't justify. They keep roles tied to revenue, efficiency, and mission-critical systems. So one of the best recession strategies is to make yourself closer to the center of value creation. That could mean learning data skills, learning sales, learning operations, learning automation, learning how to manage projects, learning how to solve problems that save money or increase revenue in tough times. The people who can do that are more likely to stay employed or at least to find the next thing faster. Now, I'll say something here that sounds obvious, but most people don't act on. The time to build that employability is not when you get laid off. The time to build it is now, while you're still employed, while you still have a routine, while the urgency is low enough that you can learn with patience instead of desperation. That ties into the fourth core idea, investing in yourself. But let's expand it beyond take a course. Investing in yourself in a recession means you use the slower period to upgrade your future earning power. You treat learning like a serious project. You pick a skill that the market rewards. You practice it until it's real. You build proof, a portfolio, a certification, a set of case studies, something you can show. And I'm going to be blunt. The biggest difference between people who learn and people who level up is that the second group builds output. They don't just watch videos. They create, they ship, they solve. They produce something that can be measured. If you're learning coding, build a small app. If you're learning data analysis, analyze the data set and publish the story. If you're learning marketing, run a small campaign for local business and document results. If you're learning design, create a set of designs and show your process. If you're learning AI tools, demonstrate how you can automate a workflow and save time. Because in a recession, hiring managers and clients become skeptical. They don't want vague claims. They want proof. And proof is what breaks you out of the crowd. Now, the fifth idea was thinking long term. And this is where people with resources have the biggest advantage, because long-term thinking is easier when you're not fighting immediate fires. But here's the good news. Long-term thinking is still possible, even if you're not wealthy, as long as you build even a little bit of slack. A small emergency fund, reduced high-interest debt, a modest investment plan, a skill plan, a side income plan. These create just enough breathing room that you can lift your head up and see beyond next month. And long-term thinking isn't just hold stocks. It's also understanding what trends survive recessions. Recessions don't stop the future. They often accelerate it. They force efficiency. They force innovation. They push companies to adopt technology that saves money. They reshape consumer behavior. They reveal what is essential and what is luxury. So when you think long-term, you ask, what will people still need no matter what? Healthcare, education, energy, food, housing, connectivity, security, productivity. And then you look at your own life and ask, what skill can I build that ties into those durable needs? What business can I build that helps people solve expensive problems? What investments align with long-run fundamentals instead of short-term hype? And I want to add one more long-term point that's practical and personal. In recessions, your reputation matters more. Your relationships matter more. People remember who stayed steady, who helped, who delivered, who was reliable when things got hard. That's why people with resources keep building networks during recessions. They keep showing up. They keep offering value. They keep planting seeds because they know the next expansion will come. And the relationships you build in the contraction often pay off in the expansion. Now, let me pull all of this together into something you can actually use without turning this into some complicated theory. If I had to reduce recession resilience to a simple framework, it would be this: reduce fragility, increase options, keep learning, keep investing, don't let fear drive the big decisions. Reducing fragility means controlling high interest debt, because debt is what turns volatility into disaster. It means having some cash buffer. It means living below your maximum. It means not building a lifestyle that collapses if you miss 2 paychecks. It means thinking about insurance and basic protections, not because it's exciting, but because one bad event can wipe out years of progress. Increasing options means building additional income streams, even small ones. It means investing in skills that make you employable across industries. It means keeping your resume and portfolio ready before you need them. It means knowing what your expenses truly are and where you can cut without destroying your life. Keeping learning means you treat downturns like training seasons. You read, you practice, you build output, you aim your effort at what the next economy will reward. And you do it consistently, not in one burst of motivation that fades. Keeping investing means you avoid the trap of trying to outguess the cycle. You create an allocation that matches your risk tolerance. You automate contributions if you can. You rebalance instead of reacting. You hold through fear because you understand that recoveries are how wealth gets built. The S&P 500 didn't just recover after 2008. It went on to deliver massive gains in the decade that followed. But those gains only helped the people who stayed in the game. And finally, don't let fear drive big decisions means you slow down when you feel urgent. You recognize the emotional spike. You talk to someone you trust. You look at history. You remember that this feels permanent is almost always the lie fear tells you. You make decisions based on process, not on panic. Now, I'm not your financial advisor, and everyone's situation's different. And there are people who truly cannot invest because they're surviving. I respect that. But even then, the principles still matter, because the first step is not buy stocks. The first step is reduce fragility, build that first layer of slack. Even a small buffer changes your life. Even a small side income changes your life. Even a single new skill changes your life. And I'll end with a thought that I wish more people heard earlier. Wealth is not just about money. It's about security, freedom, and options. It's about not living in constant fear that one bad month will ruin you. And while the system isn't fair and luck is real and opportunity is uneven, there are still moves you can make that compound over time. You can build a buffer, you can build a skill, you can build an extra income stream, you can build a process that protects you from your own emotions, you can build patience. So if you're listening to this and you want to be ready for the next recession, don't wait for the news to scare you into action. Start now. Start small. Build slack, build skills, build options. Set up a simple investing process you can stick with. And when the next downturn hits, you won't need to be fearless. You just need to be prepared enough that fear doesn't control you.